Yep, you good.
I'd like to call to order this regularly scheduled Board of Finance meeting for Wednesday, November 10th, 2021. Let's start with the Pledge of Allegiance. Pledge
Allegiance to the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Public comments, seeing no public here, I'll move on. Before we get into communication and correspondence, we have Tom DeVonzo joining us tonight as the new member of the Board of Finance. And Mary Capiello is here as well. She will be joining us in the next month as well, so welcome. On to the communications and correspondence.
We did not have
Okay. Approval of the minutes.
any. Do you want to make that since I wasn't here last
Okay,
time?
I'll make a motion to approve the minutes of the October 13th regular Board of Finance meeting.
I'll second it for discussion. Tom, for voting, and Mary, since you're here, even if you're not present, if you read the meetings and minute meetings, you can vote on them. If you don't read them and you're not present, you can abstain as well on the vote. I don't think you got these meeting minutes, probably not. Since it was also happening and so new, the three of us can
Yeah, I
vote
read
on
it.
this. So I'll make the motion that we vote. All those in favor? Aye. All those in abstention? Yep, perfect. Thank you. The first selectman, Mr. Dunn, is not here this evening, so Marcia will be giving his meeting minutes. Before we get into that, I'd like to thank Steve for his service to the town. It was a pleasure working with him, and he really brought us all together, and I'd like to thank him for that and his work to get us where we're at. So thank you. You want to add anything, or are we all good?
Who said it?
You said it.
All right. Thank you. Marcia, you're Steve right now.
All right, and Steve is not feeling well today. He had a booster shot yesterday. So he asked me to report on this. Streetscape Phase 6 has gone to Westcott for review and possible approval of the lot SIP grant request. The TAG group of Westcog, that's a subgroup, met this week to do the review. There were 9 grants requested. They approved 5 of them. One of the approved ones is Brookfield's. As you may recall, we asked for a grant of $3.8 million with $3,572,000 to be paid for with the lot SIP grant and $228,000 to be paid for with town funding. This would have 94% of the project paid for with the lot SIP grant. The project would extend the streetscape up Laurel Hill Road to Station Road. Second, the annual audit is finished. The OPEB documentation came back, and we are on target to complete the audit by the end of the year as we had planned. 3, the committee to review capital requests has been sent all of the requested capital projects with the exception of 2 or 3 items that will still get to them shortly. Ricky Ramos will be convening the committee in the next week or so to start their deliberations. They plan on having a recommendation to the town and the boards before the budget season starts next year. This plan will give the boards more in-depth and detailed review of the capital needs and should make the board's decision for next year's budget more transparent and complete. That's it.
Do we have time? Let's go back to that. Can I just see that, Marcia, quick?
Give it to Diane when you're done.
Yeah. A few things I want to talk about. One, we did not approve the project for LoSiP yet.
Correct, we discussed it at
We
the last
discussed it
meeting.
at the last meeting. So is there a time limit on that we need to, can you find that out for
Yep, I
us?
can find that out.
Because I don't feel comfortable, one, voting without Dan.
Right.
2, I think this should probably, if we have time, go through the new first selectman and our transition team.
I think that nobody has, I'm just trying to go on memory, I think that nobody has approved that yet. All they were looking for was a letter of support, if I remember what happened at the last meeting properly. Is
Right.
that,
Because it hasn't even come through the Board of Selectmen to us as a motion to approve.
Right.
can
So, and then
you
it
look
goes
at
to
the
town.
minutes
Yeah.
and see what, what we
So-
said last month, but I thought it was just a motion to support, because it should go to a town meeting and
Yeah.
everything, so I think that that's understood, but I'm gonna find out.
If we need to do something, we'll hold a special meeting. We could do a virtual.
It said, Dembowski gave the board an overview of Streetscape Phase 6. This agenda item will be discussed further at the November BOF meeting. And you made the motion to move it under new business on the next agenda.
Mhm.
So, but we don't have a full
Yeah.
board or anything.
I would feel better, and I would like to probably, like I say, move this to the new first select person. And let her and her team handle this. The other thing was the capital committee, I wanna make a statement on that too, is, and we can discuss around that, is I would like to, even though Ricky was not voted in as a Board of Finance member, I would like to support Ricky as being the committee chairman. I know we don't have a say as a Board of Finance, but I'd like to strongly say we support Ricky in that role, to continue in that role and work with us. Again, I don't know what the first selectman and our transition team have to say about that, and from our point of view, we'd like to keep Ricky in the capital project because of his knowledge, his work with the Board of Finance, and his work with you, Marcia, as well.
And I think Ryan was also on it.
I would also like to support that Ryan is also a member, again, that's between the first selectman and our transition team. But we would like to strongly suggest, not that I think we're getting heard, but strongly suggest that that remains intact. Any other comments? All right, there you go, Diane. Thank you. All right, now it's on to being Marcia. Rosa's on her way, so Rosa will be joining us for the Board of Ed as well.
All right. Let's see. Doesn't stay up on the screen, I don't know why. But once I start using it, it does. All right, so a few things that you received, the year-to-date operating budget that, for expenditures. We tried to get it done for the Board of Selectmen's meeting, which was the first day of the month. It's the one on legal size paper. That we tried to get it done for the first day of the month, so we had, a few hours to do it. They didn't see it in time, so they didn't approve any of the transfers because they didn't have a chance to review it. So we're not asking you to approve any transfers at this meeting. With respect to changes that, and for Mary and Tom, that if we look at the columns, this was, the first column is the budget that was already approved. The second column is the budget that, budget adjustments that have already been approved. There's been one because of the way it works for the Candlewood Lake Authority, that if a number of towns approve the bigger budget, we have to approve it. So that's the only change that's been made so far. Intra-department changes are things that go just to the Board of Selectmen that the Board of Finance doesn't need to address. And then we have inter-department changes that that's money that goes between departments, and that has to be approved by the Board of Finance. Revised budget, what our year-to-date expenditures are, what the variance is right now, the percent spent, and then what we expect to spend at the end of the year. And if you look, there's a formula in there that we always expect to spend exactly what we have, unless we have some information that tells us otherwise. So if we think we're going to be over, we think we're going to be short, we meet with each department head every quarter, and then more frequently at the end of the year to try and get that information. And I have to say that they're much more forthcoming about telling us when they need more money than giving up any money during the year.
How about that?
And if the percent looks weird, like we've spent 100%, I try to make a little comment in there, like insurances, we've spent 100%, or software, we spend that up front. So just to, if there's anything that stuck out to me, but feel free to ask questions on anything else. And then in red, you know, we're doing this and trying to get it done, like this was, we had 6 hours to get it done. If there's little notes to myself on, oh, we've got to fix this, or we've got to do that, I try to just put it in red so I remember to do that. So as far as what the inter-department transfers are, what we're proposing is we need some increases. The IT software that we talked about getting, and see if I can sound intelligent in front of Dan, that we talked about having cybersecurity insurance, that we used to have it as part of our policy, automatically free, probably didn't cover much. But now we're looking to have cybersecurity. It's no longer, they will no longer do it as part of any policy, and they're very strict about doing it. And she said, even if, you know, we were exactly what they wanted in July, now that we're in November, they want more. As this gets riskier and riskier, more companies are dropping out, the prices are changing. So as part of that, we needed multi-factor authentication on everything that we do, so that if you try to get your email on your cell phone, you've got to go to this little thing and look it up. So Steve had called together all the IT teams. Dan Secor is the town's IT hero. Eric Conklin is at the Board of Ed. We've got Matt at the police station and Jen at the library, and then there's one at WPCA. To try and go through the whole IT thing, to do it as a coordinated effort, to look at the different softwares. So the big thing is we need additional money for this multi-factor authentication, one for Microsoft, and I think that's about $11,000, and one for Duo is the name of the company that we're going to work with. It's owned by Citrix. Cisco, thank you. And so that is approximately 16,000 of what we need more money for. And then the second thing that we're going to need more money for, the big thing, is we use a thing called seamless docs, and that is the forms that we use for land use, that work you're going to fill out, forms that would be sent directly in. That's called seamless docs. It was sold to a new company, and it raised its price $4,000 from last year. From the first time we bought it was a 3-year, so it went up from that. So that's what IT needs more money for. Land use, as you've seen, that they have this whole COVID thing has really spurred on people to fix up their houses and do building permits and all that. So they are swamped down there. They're looking for additional staffing. That they've had this. When we did the budget, we said let's assume that COVID would be over, but the effects of COVID are not all over, and so they need more staffing. And they did have somebody, a college student, that was doing it, and we had posted it to. We had posted it to sporadic pay. And they'd like it to be more consistent, and so for consistent pay, we just post it to part-time, so that sporadic, you can't say, oh, halfway through the year, halfway through the budget, that's how it works. When it's consistent, we try to do it into part-time, but it's the same salary, it's the same as what we have been paying, but we were just putting it in the budget and transferring money throughout the year. So that, we're looking for the money there. Blight, Blight, we have a number of cases going on, legal cases, that, so for that, when they have a new blight case with with legal fees. They estimate it'll be about $2,500, and they put in a purchase order for $2,500 for each one, so we can kind of earmark the cases. Some are 500, some are 4,000, but that's where we start to try and track it. So right now, it's looking like our blight legal fees are going over. Firefighter stipends, that we don't have the actual list when we do the budget, and one additional firefighter qualified for the stipend this year, so we have more than the budget. I think there's 3 more than last year, so we need $1,500 there. Where would we get the money from? For right now, under property insurance, we're not buying the cyber stuff. We've got to get this stuff done first, and then we'll look at cyber. So we're looking to transfer money out of the cybersecurity insurance. Fire marshal, the fire marshal is on military leave. He is with the National Guard. And so he will be out until, last I heard was mid-December, so we have some excess there. And we've got a separate fund for heart and hypertension, and we were funding that, it was underwater, and we were funding that a little bit at a time. One of the beneficiaries of that fund, so when a police officer has these problems, we are required to pay these bills. Sadly, one of the retired police officers passed away, but that means that we don't have that liability anymore, so we don't need to transfer that money anymore. And then I just wanted to put at the bottom that the CSEA, we have money in contingency to pay. Their contract wasn't done as of the time we did the budget. We had money in contingency to pay that. The contract is still not signed, so as soon as that contract is signed, we are going to have to make a transfer from contingency to the various categories. So that is everything on operating. Does anyone have any questions on operating?
For the IT software, the cybersecurity, multi-factor stuff, that's going to be a new expense annually going forward? Okay. And I
Yes.
know, I thought we've had some authentication stuff already in place. It's just that it's expanded to more things.
So it needs to be on every program, every computer, and so we've had it on some that, and some programs, but it needs to be across the board, no exceptions.
And how does this impact our insurance rate that we get for having all of this cybersecurity? Do we get a
well,
discount, or right now nobody will underwrite us?
So right now, we don't have insurance, insurance for that.
Okay.
And we need to do this to meet the minimum qualifications to get insurance.
So they will underwrite us, okay.
Well,
Yeah,
we don't know if that's, she's
Oh.
given us a lot of
Yeah.
cautions that,
Yeah.
last year they would have underwritten us without this year
Insurance.
they wouldn't.
Yeah.
And she said that it's just, they're trying to shop it out to all different places every time a town comes up with this, that,
Okay. Okay.
So then you said that we probably won't qualify for it during this fiscal year for the cyber insurance. So
we
that's
hope
how-
to.
Oh, we
but-
hope to,
but-
okay.
And so then we'd have to find the money to, where to get that, we'd have to see how much it
Okay.
is. We were thinking it was gonna be about 16,000 for our side. The Board of Ed is going through the same thing on their side.
Yeah.
But we don't know how much it's gonna be. That was the quote from last year.
Okay.
We don't know this year what it's
So
gonna
then all of that could wait another month, correct?
be. It's gonna have to wait another month because the selectmen didn't approve it, correct?
Okay.
And it can all wait, yes.
Okay.
Nothing is over budget, it's just anticipated to be over budget. Any other questions on the operating?
I just had a question on the insurance.
Okay.
What's our liability if somebody breaks into our system and steals the data?
Um,
Do we know?
So we would be required to report it.
Okay.
My guess is that we're required to mitigate the, from what I see on other places.
Yeah.
And so I'm just talking off the top of my head.
And offer some kind of life lock for a
Correct.
couple of years or
That-
something like that, so.
Yeah, our bigger risk would be if they come in for ransomware, where, if we have to pay the ransomware. I think that that's right now is what's happening more often than stealing data.
Okay. And all municipalities have the same problem of getting underwritten? Right.
So, our insurance, we use KERMA, and KERMA is a vehicle of the Connecticut Council of Municipalities, so they only do municipalities in Connecticut. And I think of the 169, they probably do 150.
Oh.
And so their 150 are having problems. I don't know about the other miscellaneous
Oh,
ones.
so 150 of them are having an issue in getting underwritten?
That's what she's telling us, yes.
Oh, okay.
Yeah, because she's,
Yeah, we may want it self-insured, we'll talk about that later.
all right, well, that's kind of what we're doing now.
Yeah, I mean, right now, we're on the,
We're doing that.
on the tight
I
road.
think that's more of a Board of Selectmen, that's not our purview.
No, I'm just saying.
That's not our purview, it's not our meeting, not our purview. Thank you.
All right, any other questions on operating?
Can we make a motion to move Rosa next?
Over here so the mic will pick me up.
Do you need me to?
Okay.
Oh, the
All
whole
those in
room's good?
favor,
Okay.
Eileen, so we can move all
Yeah,
in favor?
yeah,
If you want to pull up the financial report, you can, but I can just sort of talk to it if you guys want.
Okay.
But, okay, so the finance committee met on Monday evening. We do still
can-
have,
Have a meeting with Rosa.
sorry, what?
I'm sorry.
keep going.
So we do still have a projected surplus, but it's down a bit from last month, so we're looking at around 114,000. Month to month, we've seen increases in substitutes, particularly for an interim principal, as Mr. Belanda is going to be out for at least the next month. Special ed transportation is also up. We've had issues finding drivers, finding vehicles, and unfortunately, we've had some behavioral issues on some of the shared rides. So if you remember, we combined a lot of the rides, and now we're having some behavioral issues with those kids, so they need to be split up into separate vehicles. In terms of special ed tuition, there are some things that we're gonna need to keep an eye on, so I wanted you guys to be aware of those. We have some changes coming, a lot of it's still unknown, but I wanna kind of give you like a little bit of a breakdown of what we're looking at just for context. So it's more information than you need, but it gives you, I think, a good picture. So for example, we have one student that's moving out of the district. That might decrease our costs by about 50,000, but that figure is not finalized yet. We have one student whose services are going to be increasing by about 30,000. Another student with new medical issues that might lead to an outplacement. Another student's moving in, and there's PPTs being scheduled, so who knows what that might mean. That might mean an outplacement as well. There's also a few kids in the school with some behavioral issues, so we're gonna have to keep an eye on those, and those might increase some of our costs. We know that we need to pin this down. Obviously, we're getting ready to create our own budget. So hopefully by next month, we'll have some more solid information on that. One thing that we have, so as you know, we have the special ed tuition reconciliation sheet. One thing that the committee has requested is that we also have another section on emerging issues, so we can kind of have a somewhat of a flow in terms of what we're looking at. Have some of these issues gone away, have new ones popped up, so we have that hopefully coming forward. Just a couple of things that we had on, that I had mentioned I think last month was, so we have some of these unbudgeted costs, right? We talked about the CABE policy services, it was like 3,600. That interim principal, that's costing 10,000 alone. And our enrollment study at about 1,500. So those are some of like the very small, pretty insignificant but unbudgeted costs. You probably noticed that Center School roof was getting replaced. You probably noticed the work being done on that. That's costing 14,000, but it's something that we've absorbed within the maintenance budget, so even that part is totally fine. And unfortunately, that was just something that we don't like to make changes to a building that we're going to be moving out of soon, but it was a very necessary change. We tried to patch that leak so many times and it just wasn't working. So that is, let's see, that's pretty much it in terms of our costs. So yeah, I know that was a lot of information thrown at you, but happy to answer any questions if you have any.
Well, we'll clarify something off the bat, that you have to go through the Board of Selectmen. We can't speak for the Board of Selectmen anymore, that's Turner transition team again. But we, as a group, and most of us are still here, promise to support the education on these needs. We stripped you down in your budget, we took away your contingencies, or didn't take them away, but we agreed to hold them on our side. So from our point of view, I think I can speak from at least 4 of us, that the support is still there. We gave our word, and we're still on this board, and we will support that. But we can't speak for the Board of Selectmen right now. So I need you to understand that.
Yeah, no,
The process goes
could
from
you
you
clarify
to
what you
them.
mean by that? I mean, so-
You would have to ask
Yeah.
for a special appropriation through
Oh,
the
okay.
Board of Selectmen.
Yeah, well, we
They
don't
then
need one.
pass it on.
We
I
don't
know,
need
I'm
one
just
yet,
saying if
but
you
okay,
do,
Okay,
then
Yeah.
it goes to, what I'm saying is,
Yeah.
from our point of view, we would support your,
Oh,
because of the
okay.
way we've worked this out and agreed to this. That was part of our agreement from last year. So, okay?
understood.
Any questions for Rosa, please?
No, as always, it was perfectly transparent and understood.
Thank you very much.
Thank you.
And good luck on your new team.
Thank you very much. Yeah, same to you.
And congratulations on your reelection.
Oh, thank you. And to you as well.
All right, Marcia, thank you. Go ahead, Marcia.
All right. So let's go on to the capital that, back on the screen, that, you have the capital budget. It is the other one, but it is all numbers, but it is letter size. And with respect to that, just pointing out some things that they're the ones that are in the orange highlights. Again, we met with each of the departments. We met with each of the departments on this. And talked about where they stood on their capital. That and so what the orange highlights mean, reval, is I have to make a transfer, that we did the revaluation, and some of the things that we used to pay out of operating, they included in their capital, their big capital expenditure, the proposal did, the vendor did. So there'll be some money being transferred over there from operating. Financing, this was as of September 30th, so we have an encumbrance for financing costs, but the actual financing costs happened in October when, and we still have to allocate that some of it, there's a spot in the school budget for financing costs, there's some here, and then there's some that will go to the WPCA. The electric vehicle, that I was transferring that out because that was our portion of a grant and we did not get the grant. That
We did not get the grant.
it's
For the 4 vehicles that we went
Correct.
through?
correct. And I don't know the circumstances of that, but Steve knows the circumstances.
But that's the first time we've been told about that we didn't get the grant.
Okay.
Okay.
So I don't really know this, if the state was waiting for the grant and the state didn't get it, I don't know any of the circumstances there. The library windows, I just didn't see the encumbrance, but they were ordered and encumbered after September 30th. They're coming in, and I believe that whole project is gonna be under budget. The development projects, we talked about this, there's some projects here we have to do, for example, the Still River Greenway, we have to do plans in order to try to get the grant. So we would need preliminary architectural plans or engineering plans. And so one of the things, but we don't ever have a budget for that. And so one of the things that I was thinking is that maybe we take and put in a budget for professional plans for engineering, for any of these things that we want to do it so that we can try to get these grants. but we also wanna follow the rules and have a budget before we spend it. So, maybe next year we put it in the operating budget, or we put it in the capital budget and paid for with cash for potential engineering studies. So that's what we want to talk about there.
I think we do want to talk about these things, but we've got to be careful of where we go with this budget number, if we're a lot of add-ins. We seem to be getting a push to have it go down, the taxes, so we got to be careful on add-ins.
Correct. And it could go under part of the capital budget. But to be honest, we've been spending those anyway. That we just want. I would like to have the budget first. And then streetscape phase 2. That we have to close some purchase orders there. We did close, so that encumbrance is higher than it should be. And then the Board of Ed, they haven't had a chance to meet with us on their capital yet, but some need to be reallocated to the proper accounts. So any questions on the capital projects?
I want to go back to those electric vehicles too, because we had the electric vehicle charging station in there too. Are we doing that now or no? That's 40-something thousand.
That was all the same grant, as I understand it. And again, Steve and Greg, that has not been through my office, so I'm a little out of touch. I know that there's other things, other grants that are now coming up, and part of this infrastructure bill with the federal government handles some of that, but I cannot speak intelligently to that.
Hopefully the new first selectman and her team can. How's
Or
that?
I could find out more, but I just don't know it right now.
Okay, perfect. We look forward to
All right.
hearing that.
Um,
Sure, put it on the agenda. Let's have answers.
All right. Any other questions on capital, the capital spending? Audit update. The auditors have been here. Last month we reported 3 open items. OPEB, we were waiting for the actuaries on that. We received that on Friday. The WPCA was having an issue with their receivables. We've spent an awful lot of time trying to figure that out. We've figured that out and shared that with them and with their accountant. Capital asset reporting, Kevin, our senior accountant, I have to say, has done a wonderful job. That this year we had an inventory of capital assets. And we've had a capital asset listing, which, to be honest, auditors did year after year. Nothing against auditors, they're wonderful people, but they don't know when we delete something. That and when I was an auditor for 35 years, I didn't know either. That so they can say, oh, this was added, this was added. So we had a list of capital items for insurance. We had a list for the financial statements. Each department had a list. The auditors had a list, and he went through all of those lists and organized them and combined them. So we will have a prior period adjustment to report that we found, some things had not been picked up, but by the most part, things had not been subtracted off. And so what we're working on is taking the capital assets, and now that we have a good list, this is just the town side, we didn't do WPCA, we didn't do the Board of Ed, taking that list and then putting a structure around it for a disposal policy and annual inventory, so that the department heads take a physical inventory and they're responsible to say what happened to anything that's missing. So we're working on
And that would be scalable to the Board of Ed and scalable to the WPCA, more
Yes.
likely?
yes, WPCA would be easy, they're just little, and they've got pipes that don't go far. That one is, the outside company is called Industrial Appraisals that did the physical inventory for us to get started with. We've cleaned it up, we've sent it back to them. They say, oh, well, it'll take us a few weeks to review it. And we've said, no, don't review it. Just calculate it. And we may end up calculating depreciation and accumulated depreciation ourselves. It's not a hard thing, but we would like it in their system because it's a much better database, and it's like $500 a year. That better database than Excel. I talked to the auditors about getting them the statements by Thanksgiving break, which is going to be tight because we're also working on getting the time clocks up and running for that and training all the people.
And we're gonna do the time clocks for everybody, so we can track projects and everything else.
It depends on we have a difference of opinion on that. I would like to do it because I think it gives us some good data that if this department asks for an additional person and they've got everyone, all the salary people working 10 hours extra a week, versus this department wants another person and the salary people aren't putting any extra time, that tells me a lot on which one should get the extra person.
And where's the resistance coming from?
HR is not on board with that.
So this becomes a first selectman
Correct,
call.
correct.
Well, again, her and her team can hopefully address this.
But for right now, and we don't have to do it all at the same time. We could, right now we're starting running parallel systems on November 29th. The first of the year we'll go live with dropping our old system. And one of the reasons we have to do this is our old system does what's called bulk hours, that if you're here, you put in 7 hours. Well, if you're hourly, it's us, the state law is that this is the time I started, this is the time I ended. We don't have that data now. So, and it's gonna be a really cool system that once we get there. So those are the two things I'm juggling to try and get done before Thanksgiving break. The financial statements have to get done. We do the financial statements internally. They have to get done to give the auditors time to get it out for December 31st. But also that we have to sign a management representation letter to say that, this is we're one set of books, we're not lying, we're not cheating, that, we want the management that was here at the time of the financial statements and of the year to sign that letter. So we want Steve to sign it before he goes. So that's our pressure there. Any questions on the audit update?
What if he doesn't?
Well,
What if he?
I
doesn't
still sign it,
Okay.
the Board of Ed still signs it.
Okay.
I have not heard, I have
I
no
don't think
reason.
you won't, but I'm just saying, what if the
Yeah,
first selectman?
the new first selectman
would have
could
to?
sign it as well,
Okay.
and let's say, before I started here, I was a government auditor, and what we would do is, we might get 2 of them, so the selectman that was here signs it before they go, and then the next selectman signs it. Let's say there's another 30 days to say, hey, as far as I know, and so she's not gonna know unless, she's got a big subpoena that came in the day before. We want to know.
I'm sure Steve is signing this document.
Oh,
I'm sure this is,
Yeah, I don't
I'm
think
sure
it's
Steve
gonna be a
is signing it, so I wouldn't worry about it.
Um,
Also, when you're doing this report, I appreciate it. I think you hit on Kevin. If you can't make a meeting, maybe you should have Kevin come and give it to us. I think give him a little exposure to us, if you don't mind.
Sure. You've already told me you don't want me on the capital committee, so, and you want him instead.
Whoa, I didn't make that
Who
call.
said that?
I think it might have been Ricky. He didn't quite say it that way.
Good old Richard.
But yeah, no, he's doing what we have a part-time, you approved a part-time senior accountant. She started today. And so that should free him up for some more special projects and things.
Yeah, I'm just saying, if you can't make it, just to give him a little bit of exposure, I think we would all accept him coming to the table and to sit with us. How's that?
Okay, if you're nice to him.
Accounts are hard to come by,
Yeah.
good ones.
All right, Dan's not here, so
Oh.
he won't, so what are you gonna bring up there? Go ahead.
Are we done on audit?
I'm okay.
Yeah, absolutely, I'm fine with Dan's not here.
Anything else?
Debt bubble.
No, no, audit.
Oh, anything else?
Stands out for you, right? All good?
No, just the pressure of trying to get it out. They've done most of their field work. I've sent them the OPEB that came in on Friday. I sent them the WPCA changes. We've given them, or we are going to, whether we did or not today, the capital assets. So, and I tried to get them to promise they would get it out by December 31st, and no one's making any promises. But. So this is the debt bubble. You had asked us to update those numbers based on the actual debt that came in. And so let me, Steve was not really fond of this graph. So let me tell you what's what. The,
You want me to do it?
Alright. Yeah. So, maybe if there's people watching on TV, I should do it here. Alright, I'll do it here. So this yellow line, the last year before we had the new school debt, this was, the yellow line is how much debt we had. So we're using that as a baseline of this is what our normal debt might be.
Debt service, right?
Debt service, principal and interest. And this green line, this green bar, is what our actual debt is as of today. That every year we'll be probably adding more debt for the annual capital projects. But this includes what we bonded in October for the second half of the school. In order to cover that, this black bar is how many mills our taxes will have to go up. And so this little bump here, this little bubble here, is the debt bubble. And the way, and we want to bring that down. We don't want the taxes to go up that high. We don't want them to go up at all, but we understand that we have a $78 million school, we've got to pay for it. So what are we doing? And the debt bubble, it goes down, the payments go down once the high school debt goes off the books. So these years that we have high school and Candlewood Lake Elementary School are what causes, that overlap is causing this bubble. So how are we going to take care of that? And we saw this bubble coming when we did our 10-year model. So the way we're talking about taking care of that is with one-time revenues. So this one-time revenue in the current fiscal year is the premium from last year. When we did the bonds, we earned a premium, $1.6 million. Or we used 1.6 of it.
1.8. We can only use so much of it.
Correct. We have to use that premium to offset debt. So we didn't have a choice to push that off, to offset debt service. We now know that we earned a premium this year. That premium has to be used to offset debt service, and we've got 12, 16 months, whatever it is, to use it. So that, I would say, that we put against revenue, to offset taxes next year. So that's what this is.
How much is it?
This year's premium was 1.4 million.
And we can use all the whole 1.4 to offset, or
Um,
only part as a
we could,
percentage of it?
I haven't looked at, it's the tax regulatory agreement that tells us how much we have to use.
Okay.
And to be honest, I haven't looked to see how much we have to use. I would think we want to use it all.
Yeah.
But I haven't looked to see, but I will by the time we
Okay.
do the budget. So that's what is offsetting us this year. Then we have two one-time sources left, and I'm trying to remember back to my worksheet that I sent you, that we have the potentially ARPA money, there's a thing with ARPA with lost revenue. And so if we could take that and offset our expenditures, we can directly offset the taxes. And there's a few steps that we have to go through first. This week, some of the compliance information came out. So one of the things we were worried about, I was worried about, was, okay, could we take ARPA, it's gotta be something town-wide, and let's say paving. We could use it against paving, so use ARPA money and the lost revenue money instead of taxes. However, up until this week, we didn't know what the compliance rules were going to be. There's it's called Uniform Grant Guidance that the federal government makes us follow, and one of those is Davis-Bacon wages. If we spend this federal money on paving, are we going to have to do Davis-Bacon wages? So our 1.5 million of paving goes up to 2.25 million. Does that make a lot of sense? In the new compliance information that just came out on the 5th, we do not have to follow that. So that should make it easier for us to use this. I'll make a list of what might qualify, make sure that we can qualify with a full 1.9 million. We were going to have this pre-audited. The auditors are going to have to audit this before we spend it. We want them to audit it before, they're going to have to audit it before we issue the financial statements when we spend it. We want them to audit that calculation now, because we don't want them to say, oh no, I don't think it's 1.9 million, I think it's 1.2 million, and all of a sudden we're out. But we were waiting to after we figure out who the auditors are going to be. So there's 1.9 million, and then we have some fund balance set aside that makes up this, and these are a combination of, these two are a combination of the lost revenue and fund balance. I forgot exactly how I allocated the two. But then, this is what the mill rate increase would look like. And
If we use those funds.
If we use those
right,
funds.
okay.
Yeah, so that it kind of smooths the bubble, that yes, taxes are going to go up for debt, what we need to cover for the debt, but they're not going to go wild like
Does
this.
that include the new appraisals that they've done for homes?
So,
Or that red line, does that include that?
so this
Where
is
would that
just,
affect
The mill rate. I'm just saying, your home gets
the
is worth
same amount
more
of
money.
dollars? It's gonna be the same dollars though,
So-
right? So
Well,
your
it's the-
valuation
it's the-
versus the
It's the
budget.
tax, whatever you're charging percentage on tax increase or whatever,
so,
times the mill rate. So if your house is
correct.
appraised at a higher rate, so that even if your mill stays the same, you're gonna
So-
pay more in taxes, so.
So I wanted to try and keep it
Okay.
level. That I didn't want, because Steve said, well, maybe we should assume that the grand list goes up 2% a year. Okay, but then we've got too many assumptions in
Yeah,
that.
yeah, that's
So
too many
then
variables, so.
so this is just for, to explain the debt bubble and not to set the taxes. So
Okay.
the reval, the
Yeah, the
property
reval.
will go up.
Mhm.
The mill rate will go down, so
Mhm.
maybe what was 1%, 1 mil here might be,
Yeah,
you know,
that's
point.
what I
But ultimately, it's the same revenue. Ultimately,
Well,
it's
it's gotta
still gonna
be.
bring
It's
in the
gotta-
same revenue,
It's
so
gotta,
it's
somehow it's gotta equal out. Either gonna raise the
Correct.
percent, or you're gonna do something with the
it's
mill
still
rate. So it
dollars
doesn't
spent.
matter. Yeah,
It's still
exactly.
dollars spent, so if the mill
Yeah.
rate dropped 3 mils, it's
Well, I was
irrelevant
just
to
wondering,
the
my
payment.
question was, is that reflective of the new,
No,
because
we
a
tried,
drop in the mill rate, so it's not, so that's fine.
yeah, we
All right.
tried to keep it, we just didn't want, because once we start, like with his suggestion of putting in the mill, the grand list grows every year, okay, but then we've got to start explaining, this is a growth, and then it doesn't look like it's a fair comparison. So that's flat
Okay.
based on the 2022 grand list. All right, does it, so I thought, I kind of liked this graph. He wanted it a lot simpler, and maybe if we give it to citizens, we do it a lot simpler, that it,
I think they
And
call
this
it
is
coding,
just
too.
strictly debt. This has nothing
This
to do with
just
any
debt. This is
operating,
debt.
and that's what we've been
Yeah.
trying to tell people, that the operating, the Board of Ed budget is not on
Totally
there.
separate, yeah.
This will,
And there are.
so we're
poss-
1% out of the gate in a year from now. We're 1% out the gate if we gave 0 to anybody.
And this does not, there are other additional revenues coming in that, for example, it's a possible that this Iroquois will bring in significant amount of revenue. However, when we went through our initial analysis, when I started in 2018, the thought was we had a lot of debt built up over 30 years, and not a lot to show for it. And what we really needed to do was to increase our spending on capital projects every year. Instead of bonding them, paying for more and more of them, and only bonding the big stuff. And so the way we had talked about doing that in the financial model, that, and I can get you a copy of that if you don't have it, the way we talked about doing that was big new tax revenue would go directly to the capital projects budget. So that we'd like to get, we just set a number of 5 million. We were bonding at that time, or we were paying in cash at that time about $1 million. I think we're up to 2.25 million this year. We'd love to get it up to 5 million, but if you look at this year's capital request, we have 16 million. So we're not saying 5 million is the right, but we've got to just keep pushing ourselves to get more and more of that paid for with cash and not keep bonding these things.
So the ARPA committee is also looking at what capital projects we might be able to apply those funds to also. That's separate from the general fund revenue, right? So that's other things that we might take off of our capital list that will, okay,
Yes.
that's important.
They are going through it. They have 21 projects currently that they're reviewing.
Okay.
They're running it through
Ad hoc committee.
a valuation formula that they figured out. But again, that'll be up to the new first selectman.
Any other questions on the debt bubble? You had asked us to just update with the numbers.
Yeah.
No, I think this is
What-
helpful. It's a good.
I would like to see is, before we get into budget season, is running it through the status quo budget. Pay raises, insurance increases,
Right.
estimated energy increases, because I think you're gonna come up with a number that's fairly large.
So, and what I normally do is I take that, I say normally, I've only been here 3 years, but I take the pay, we know what payroll is, the increases there.
Yep.
That we have no idea what insurance is gonna do, and they will not give us an idea. So we were gonna use they won't give us an idea till next spring. So we were going to use, the actuary, because we're, at a loss. Do we say, hey, if we say 13%, we're safe, but that seems to be too much. So we were going to take the actuary's estimate for OPEB and increase it 0.5%. And we could be too high, we could be too low, but we've got a methodology at least. And so what we do is we do that. We take all the known numbers, we take the known increases, and then we, from there, we say this is how much it's going to increase if nothing else increases. And because it's been increasing a lot already, that that's how come the last 2 years we've told each of the departments 0% on anything else, unless there's something that so we give them 2 things. The police, they have no choice but to do the body worn cameras. That's a state law. And so that's an annual cost. So we made some exceptions for the things that we had no choice on. And then we give each of the departments a next priority form. If there was something else that you needed, just do one, library, if there's something else that that we could fit in the budget, what is your next priority? So you're at 0%, but I need this as a next priority. So like that part-time person that I have was our next priority
Mhm.
form. That I think there was, I think we only had like 3 next priority forms that, or 4 that were
Mhm.
approved.
Didn't have many.
So that's what we have been doing, and that's how we calculate what to tell them, as far as their budget goes. That, I do know that we do have some things, because we've talked about it in our quarterly budget meetings, that, fuel, we've been really low on fuel. We got a really good deal, because we did it extra long in COVID, and when it was really, really low, so that's gonna be a big increase.
Big hit.
A big hit. Utilities, it's time to go out to bid for electricity, but the prices are high. It's thought that they're gonna come back down, so we're holding off on that bid.
Eversource has just got approved for 21%, or going for 21% increase.
So that's gonna be an issue, that, not all, some of them
But-
are in,
Next year, we're gonna be fine. It's gonna be the budget on the budget because of our premium, correct? We equaled out the debt, correct, with the premium, the extra debt.
we did, but this year, we got a little benefit from the premium,
Mhm.
that, so we're not gonna get that benefit, so,
Right, so next year though, we're 0-0 versus the debt with the offsetting revenue.
we're behind the ball, that, for next year, from this year, because we had to use some of that. We, also have a number of items that are, the police, that what we used to do as capital expenditures, like the tasers and the police, vehicle cameras, we would buy 1 year and then wait and buy them again 5 more years. The structure has changed so that it's a subscription, so that it now has to go in every single year. That just like the body cameras, that it was every single year we have to put it in the budget. A little, not as much, but it's no longer. So it should be it should be an operating item and not a capital anymore.
Threshold on cash capital, we're up to 50,000 now for cash
We're up to
capital?
50, and yeah, that anything under 50 we try to pay for in cash. One of the things that I had given Ricky when I gave him the capital stuff is that Parks and Rec, they put on their capital things maintenance items that, and we've always done that, like we want more chips on the playground, or we need this. And what I'd like to suggest next year is, those are not capital items,
No.
those are
Annual
needed
maintenance.
every single year. So I asked her to segregate out the things that are between, capital is over 5,000. To segregate out maintenance items that are between 5,000 and 20,000. She's got it scheduled out for the 10 years. What would that look like? And that looks like that, 66,000, I'm sure, and I could give her everything she wants. So let's say it's 50,000. So 50,000 a year, she would still in her zero-based budget show us what she's planning to spend those for, but we take it out of the capital process and just fund it properly in the operating process. So I just want to say that in case, I don't want it to fall through the cracks and you have the capital committee say, no, we're not going to fund it here, and have you guys say, no, that should have been capital, that it's in there, make sure that we don't lose it someplace.
We look forward to the new first selectmen's budget and coming in under 1.5. How's that?
Yeah, so it's gonna be, but we knew, I mean, we can't build a new school without a cost.
We've been told different, so let's hope we can find a way.
All right. Any other questions on the debt bubble? Does it make sense? Isn't that the prettiest graph you've ever seen?
Love it.
It's great.
Okay, maybe that's good. I won't push it that far.
Okay, on the new business,
Down 3 dimensions.
put up the,
Oh, want to put up the outside service? Is that what we're doing first?
Yeah.
So for the new members, the police bring in revenue from outside service. If they go to other towns and do traffic watches, we get paid for that service. That revenue does not come back to the town, it goes into their police fund. So they build up a fund that gets up to $200,000 at a time. And so when they ask for certain requests, we back, or they suggest that it comes out of their outside fund. Marcia does give us those outside fund numbers at budget time, we go through them.
And the police ask for it every time before before they ask for something to make sure they know where they stand.
There's only certain things that can be used underneath this, I believe, there's certain guidelines to use it under.
There is a policy.
We try to keep it at a $100,000 to $150,000 in that account at all times, but any of the extra we try to utilize as best we can. So the police go to the Board of Selectmen, the Board of Selectmen approve it, and it comes to us for final approval. So that's what's being asked of us tonight, to approve the $10,000.
Yes. This is the policy that, for the outside service fund. And, in case that's helpful.
So this has already been approved by the Board of Selectmen, and they're looking for us to finalize it. So I'll make a motion that the Board of Finance appropriate $10,000, approve the appropriation of $10,000 from the Police Department Outside Services Fund to purchase replacement underwater communication systems for the Police Department scuba team as outlined in Chief Purcell's letter dated October 6, 2021. Do I have a second? Second. Discussion. Anybody with discussion on this? All those in favor? Aye. Motion passes 4-0. Snow removal at the new school. Marcia and I talked about this earlier. I had a call into Paul Checo. At last meeting, we, as a Board of Finance, approved $25,000 to rent equipment to remove snow for the new snow removal at the new school. It was in direct relationship to the new project being built. There's been some emails back and forth. We, as a Board of Finance, approved that under the school project. I spoke with the building committee, and he's willing to accept that $15,000 under the school project, as we had discussed. But if we can find the monies from savings in the park and rec budget, from fertilizer or anything else that we couldn't use the fields for, that we had put fields, he would like us to consider using some of that money as well to offset the $15,000 and find a way forward through this as a mutual agreement.
So why don't we post it originally to the Parks and Rec budget, and then if we can't find any place to transfer it from at the end of the year, if we're so tight that we can't cover it in the general fund budget, that we know we have the option to transfer the money in, because we could transfer it from Parks and Rec, we could transfer it from any department, including Board of Ed, that has an underage. So that seems to be, as far as the day-to-day, how to post it, that seems to be.
I think we can do that. My personal opinion is that we post it to the school project right now and we work out of that, because I was always brought up that if it's a direct correlation to the project, and if it wasn't gonna be used other than the project, if we could meet the snow needs before the project, meet the snow needs after the project, this is the direct project
Okay.
correlation. Paul said we can put it there, and then let's see where we end up
Okay.
in this mix. I will speak with Paul as well on
Just
this.
don't want to forget, but I'm sure he'll remind us.
But Paul, we gotta keep Paul in the loop when we do those things. That's probably my bad, and I accept that. Paul, accept my apologies. But I think that goes to, my opinion is it would go to the school project, because it's not something that wouldn't have needed if it wasn't for the new school being built. Now, again, if it becomes an issue, we can discuss how to move that, and again, that can be between the new first selectman and her team probably can figure that out, but I think from our point of view, we leave it as it is, as we voted it. Is that okay with you, Marcia?
That works?
Okay. Anybody else?
I think that's good.
It's appropriate.
Yeah, I'm in favor.
All right, next, we're on to the meeting schedule. Do you have that, Marcia?
I do have that someplace, whether I have it in my little file here or not, I can find it.
It's not for Angie.
At this point, I'd like to, with your permission, ask Mary to come join us at the table, if you don't mind,
So she can see
so she can see and we can have the discussion about the dates, so we don't mess her up.
We can get it up, everybody's got one.
All right, yeah, I just was, all right, we all have it.
Oh, she got it as an email
Okay.
attachment too,
So
we're
Marcia,
good.
don't, how about we're good? So is everybody's okay with January 12th, the February 9th? Did anyone cross-check this, the holidays that we don't know about?
I checked Yom Kippur and Rosh Hashanah, and we're clear on those in September and October.
Okay.
I don't have any other maybe holidays that we might get.
For all members, you can call in if you're on the road, traveling, vacation. I mean, I wouldn't want you to call in on vacation, but I mean, it's a call-in will be available, Zoom will be available as well, so, but as a general rule, we meet on the second Wednesdays of every month. If we do have a meeting that we think is important, we move it to, for all of us can attend. But if you are in agreement with these dates, Mary,
Absolutely.
Tom?
Yes. Agreement.
I don't see any
I don't
problem
see a
at
problem.
all, I'm fine with it.
Okay, so then I'll make a motion that we approve, and Mary, you can't vote unfortunately,
I
but
understand.
I just want you to be aware. I'd like to make a motion that we approve the 2022 schedule as presented to us. Do I have a second?
I'll second.
All those in favor?
Alright.
Aye. All right, motion approved. Okay, I'd like to make a motion that we add general fund policy to our agenda for tonight. Do I have a second?
I'll second.
Discussion about it. We've had this, we've discussed this at numerous meetings. This is, and John, can you join us please as well on this, the discussion? One of the things in our audit rating, and Marcia, please jump into, is we didn't have a formal general fund policy. We did really well in our ratings, but one of our minor ticks, I would, for lack of better terms, was we don't have a general fund policy in place. This has been in discussion now for quite a few months. We've made a few changes, which Marcia highlighted in red and blues, and where we've suggested. Marcia, if you could give us a little background on the percentage of the revenues and what the other towns and what the state has said.
Right, so when I started as an auditor, many, many years ago, the fund balance policy, now if you think of fund balance, it's our equity, it's on a modified accrual basis, and it's the cash flow that we have for 60 days. So you can think of it as working capital. How much working capital should we have? And years ago, the rule of thumb was 5 to 8% of your budget. Then in Connecticut, Moody's, the best
Rating.
practices are set by what rating agencies want, and by Government Finance Officers Association, which is all the government finance officers from local levels to federal levels. They have a deliberation process and things. So what should we have as a fund balance? And that 5 to 8% rule of thumb. Moody's switched to 10% in Connecticut one year when the state cut our grants mid-year, and they said, "Whoa, that's scary." That the state was in pretty bad shape. I don't know where we end up after COVID, but that affects us on will the state be able to continue to pay us our grants? And I mean, they pay millions of dollars for our teachers' retirement. So now we've got the rule of thumb, the latest and greatest rule of thumb is 2 months cash flow, which is approximately 16.6%. that, so our fund balance, which is, I can show you where, and we can have special, if you wanna, come in and meet and we can go through the financial statements and how to read them, anybody, I'd be happy to do that. That, so now they're talking that the fund balance should be 2 months cash flow, which is approximately 16% as a minimum. But the government finance officers say that's the minimum, but they have this risk template, and I didn't know if you got copies of that, the new members, so I printed it. So we went through this risk template, and what we do there is we look at extreme events, you know. Luckily, we don't have fires, we just have snowstorms and maybe an occasional tornado. We look at, is our revenue stable? And absolutely, we are fantastic on that. That with property taxes is one of the most stable. That are our expenditures stable? That where do we stand with debt? That we've got a lot of debt. We don't have a lot of pension. We're actually one of the best in the state for pension. Where do we stand for liquidity? One of these is what do we have in other funds besides the general fund? Growth and capital projects. So those are the things that we should be looking at when we do this analysis. So this set of pages is just going through and what the thought process was when we're calculating this. So that they have it, they dumbed it right down for us. That gives us a scale of 20. If we have a scale of 20, what should we have for a fund balance percentage? So, and again, we went through that, and someplace it gives us the fund, where we stand on fund balance.
18.
So that is the background of how we're trying to figure out and the methodology we're using for fund balance. This was just a little discussion of all the different, you know, Moody's calculates it one way and uses some certain numbers, and Standards and Poor's use a different number. What number should we use? So that's kind of discusses that. One of the things we get dinged on, which I can't wait to see this year, that one of the things that we get dinged on is from the rating agency is we are a lot lower than our counterparts. That they compare us to other AAA communities, and we're a lot lower. And so there's some of those graphs in here that with those comparisons. So all this is just background information of what we need to consider when we're making this policy. So then this one that says draft dated 10/4 is our latest policy, the latest draft of the policy. And so what we're saying is, one, we define fund balance. What are we using for the numerator and the denominator? So when I say 16% or 20%, it's fund balance, our equity, on a modified accrual basis, divided by revenues. And which revenues are we using? So that's what's on page 1, is just what the formula is. And we can set that formula, which we did. Page 2 is going hand in hand with a fund balance policy. Really, it's if we have a budget and we have to do additional appropriations during the year, if we didn't budget enough money to cover our expenses and something comes up, that's kind of like a black mark against us, that oh, wait a minute, you guys didn't budget well, that you have to go back to the well to get more money. So we don't want to have to go back to the well to get more money. And the way we do that is by having a contingency that in our budget, an amount that we have something horrible happen, we're gonna, or maybe even special ed costs some years, where are we gonna get that money from? It's the contingency. So, don't have a contingency policy, but what we've got here is, to go hand in hand with this, a contingency of 0.5% of the budget that, and where that came from was that's what we can do by charter without having to go to a town meeting. So then the next page, which is C on
And that's
page
generally what we've been using anyway, around the 300, 350 mark.
Yeah.
once we combined it with the Board of Ed, yes, when we had it just ours, some years it went down to like 50,000.
Right,
Yeah.
but generally when we combine, we've been running 300, 350.
Yeah. So then, because we want to do everything we can not to go back and say, oh, we have to increase the budget, we want to just shuffle the budget. That, and if we look at page 5, it says C, appropriate level for Brookfield. What should we use? And so what we've got in this policy is 18%. That if we have a fund balance of 18%, we have it a little bit higher than the minimum. We don't have it as high as this is saying that we should have it. But we're gonna look at this policy every 3 years. That, and we're gonna keep an eye out on the comparisons and things, because that's what the rating agencies do. And we have a lot of debt, so we really need to offset that. So 18%, is what we have in this policy. And then how do we get to that 18%? At the time we wrote this, it was June 30, 2020, we were at 12.93. Right now, I think we're closer to 14 after the audited financial statements are done. How do we get from where we are now to 18%? And what I'm recommending is that we take the surplus that we have. The way fund balance increases is you have a surplus during the year, more revenues, less expenditures. So that's what causes it to increase. We always budget for a balanced budget as best we can, but we have only one choice, is to come in under budget. So we should have a surplus every year unless revenue is really off. So let's say we have $1 million surplus. What we're recommending is we take half of that, put it in fund balance, and not to be touched until we get to the 18%. Take the other half of that and put it in a separate category of fund balance, available for emergency spending or some such wording like that. And then it just keeps growing naturally until we get up to the 18%. We're not budgeting for a profit. We're just taking half of what any positive variance that we have. We're taking that and adding it to it.
Can you put up the talent balance graph? Do you have that handy? What it's done in the last few years?
We talked about that in a meeting. Let me try
I know
and
you have it.
Let me try and think of where I put that.
Is it this one that's in the graph, or is that,
Yeah,
is there a more?
It's that one.
Oh,
It's in the
okay.
considerations.
Yeah, but can you put, all right, I was gonna say put it up.
I can do that.
Yeah, that way our viewers can see that.
I just wanna, and then I wanna have John and Marcia walk through to anybody who's gonna watch this and the new members of how we get to where we get to,
All
the
right.
process. Sorry.
So,
So basically, she's gonna show us a graph of the last few years, and what we've done is we've been conservative on the revenues. We don't try to project extra revenues so we can cover the expenses and lower our mill rate down. We've decreased the mill rate from 1.7 to 1.5 even, so we kept taxes relatively low at a 1.5% this year. But we have not gained that by pushing the revenues higher than what we anticipate, or pushing the limits. We've been conservative on the revenues. We've pushed down on the expenses side as well, which has allowed us to grow the general fund upward without impacting, again, a 1.75 increase 2 years ago and a 1.5 increase this year, without impacting the taxpayers. So you can see, where were we at, Marcia?
So in 2011, this is the fund balance. It's in two categories, unassigned and assigned, and those are the two we're adding together. There's other categories like restricted, but that means it's someone on the outside telling us what we can do with it, so we don't have that in here. But this is the two categories that we're looking at. So these are the dollars of fund balance. Here we are at about 4.5 million, and that goes to this axis, the bar. And the line here comes over to this axis over here. So we were at 9%, and it grew. This one, it dropped. The reason it dropped was there was an issue with capital projects, which is why we have so many of the schedules that we have in our audits. And then we've been growing it again. So 2019 we were at 12%. 2020 we're just slightly higher. 2021 were significantly higher. The primary reason was COVID. When we did the budget, we looked at, oh my goodness, what's happened to our revenues, and they just kind of dropped. And so we had to assume that it was going to continue to drop. Little did we know that the real estate market would go in a wonderful direction if you own a house. And really the only negative revenue impact we've had was interest. So that's how it got so big this year. So this is just how it's.
Some people get the opinion this general fund were too high, that this is an irrelevant number, and that was brought up even in campaigns and things about the general fund. And John, if you could talk
Yeah,
to
I
the
mean, all you
importance
have
of
to
the
do,
general
I mean,
fund.
our rating agencies have a matrix, and they score us on certain percentages where we fall in that matrix. And if we're not in that healthy range, which the GFOA document says that we should be at least 18%, we need to get up there. Or else, in the eyes of the rating agencies, we're not going to be in a healthy fiscal condition, which is what we need. So,
And what value does that have to the town?
obviously, the higher our credit rating, the lower interest we get when we issue debt. So, it's in our best interest to grow and keep growing our unassigned general fund.
And
So,
we know that we have projects coming up with the police radios, we have,
Right.
you know,
Yeah.
whatever,
Police
other
station.
school repairs that will need to happen, so we know that we need to keep those numbers in check.
Do you want to add to that, Marcia?
So I'm just pulling this up. This is one that they look at, because we have the rating call, and they ask us about this, and I'm trying to pretend I could see these numbers. These are all the AAA communities at the time we did this. Here's Brookfield. This is the percentage, this green line. This is really what's the important part of this. This green line goes over to this axis, and at that time, this is where we were. Let's see if I can see what year this was. It was probably a year behind, just because in order for us to get all the data, we have to wait till
Right.
the statements are out. When we look at this, that you can see just by looking at that we're one of the lowest at that year.
What's the purple line, the average?
That's the state average fund balance, and then the blue line from all towns, all ratings. They don't have to be AAA.
So right now, we're at like the average.
We're below average.
Below
Below average, I
this
can't read
is-
those numbers.
This
Okay.
We're
right
below.
here,
Okay.
We're
No, I
just-
mean, this currently, we're at almost 14%, you said, right?
but we don't know where the other towns stand now, because
So we don't
Oh,
know compared to-
apologize.
they may
Yes,
go up too.
apologize,
So we
yeah.
really don't want to compare
Mhm.
our 3-year-old data, or our current data with their 3-year-old data. And then the blue, and I think that we might be good, because some did some pretty scary things during.
Which we didn't do, again.
Correct.
We didn't do, yeah.
And even the bond agencies said that they thought that we were very, very responsible and some
Yeah,
did
very
some really scary.
conservative by not dipping into the general fund.
So then this blue line is the average of the towns that are shown here, the AAA communities. This is their average fund balance percent. So, so we're not only looking at our own data, but we've got to look at the comparative data. So that's what we're doing. That when we go there, and the 16% is relatively new. So that before it was the rule of thumb
10%,
as the
wasn't
minimum. Yeah, the old minimum was 10%. So I know some of these were my clients, like New Fairfield, that and they have a policy of how they're going to bring it up. So I think they're trying to get to 16%. Last time, that was 3 years ago. So last time I heard that some of the other towns that have done, most of them use the same worksheet that we did. So everyone is trying to meet the new standards and bring it up. So it would be interesting, if COVID didn't happen, I would imagine this graph would just elevate. With COVID, I'm gonna find it exciting to see this new graph.
So the green line is we were downgraded to single A plus, right? That's what it says here. That's what your fund balance would be. If you were, at least that's what it says here. A plus / A fund balance. So I'm thinking that,
No, it's assigned and unassigned fund balance.
yeah, so.
That's not A plus rating, that's
Oh,
assigned and
okay, A signed and
unassigned.
unassigned, okay.
Yeah.
Assigned and unassigned.
So our fund balance, no matter what our rating, our fund balance is gonna be the same.
Yeah.
Oh yeah, that word A is assigned thing.
Okay.
And UA is unassigned.
Okay.
And the only thing that the rating is here is these are AAA towns. That's the only place the rating comes in
Yeah,
here.
just so everybody knows, we're rated AAA by S&P, but we're still rated AA2
By Moody's,
Yeah. So we had a negative, we actually were assigned a negative outlook,
by S&P.
no, by Moody's.
Really?
But they actually lifted up to stable the last time they came in, which I think was 20, August of 20. I'm
Moody's,
sorry, 19.
Moody's was 19,
Yeah.
I think, and we have some towns, New Canaan, get both rating agencies that come in. We only hire one. We hire S&P, they're cheaper, and it's the recommendation of our financial advisor that they are better for smaller towns, that Moody's is better for bigger towns.
Yeah.
So we haven't asked them, they won't upgrade the letter grading until we pay them. They did
S&P or Moody's?
Moody's.
Yeah, they'll shadow rate us, so that's why they get that.
But they'll
Yeah.
give us they'll change the positive and negative and things. I bet they would downgrade us if they wanted, but
Well, that's so that you come to them. They shadow rate everything that if you go to one or the other one shadow rates you, and they always keep you lower than what the other guy did. That's just, so you'll come to them. So
it's the risk. It's a risk.
Yeah, it's fine. It's fine. I'm surprised because S&P is usually pretty tough on municipalities and states and sovereigns, so getting AAA is great.
Oh,
Yeah,
good.
absolutely.
Not really better.
Yeah.
If we just bump up Moody's at some point, even at AA1, because I
Yeah.
think every 3 years they're supposed to do a review, so I would think that's 22.
Would it behoove us to do that after the debt bubble, to go for Moody's rating after we've gotten past the high school? Or does that not matter?
I'm concerned about our rating either way, that, because we've now got a lot of debt, and they've said that, so one of our things on our agenda that we want to do is a debt policy, that, what are we gonna do for a debt policy, that,
So if we have a debt policy, it would look better in the eyes of Moody's or
Ah.
S&P when they're reviewing our formal documentation. They say, you also have a fund balance policy that's been formalized, and then you have a debt
yeah,
service
there's about
policy.
5
Yeah.
different policies that we want to try to work on, so there's a lot that we want to try to work on.
Okay.
Do rating agencies look at the condition of our buildings and stuff? I mean, are they gonna look at, they don't take into consideration that we're, you know, consolidating two pretty rundown schools into one brand new, and so that's a good investment. I guess,
So
for
it
the
would
town.
be, the
The
way it would be
operating.
taken in is what capital projects do you have coming up?
Mhm.
That, they ask, what big projects do you have coming up? And if we said, oh, and we've got another school next year,
Well, you should have lower maintenance costs, right, because the building is new. So
Yeah.
you'll see it in the operating budget. So we should have a better operating budget than we would if we were kept on having to repair roofs and everything else. So that's that's what they look at, and that would help
That's a
us.
plus.
And yeah, that would help us increase the balance, because we wouldn't be spending that money.
We just can't quantify that for a couple of years.
No, that's gonna take time to accrue inside the fund, but definitely heading in the right direction.
Can I just say one thing? This is great. This is awesome. The fund balance policy. So you were talking about if we did have a surplus, the proper way to handle that would be, like you said, put half of it.
well, I'm not saying that's a proper way, I'm saying that that's what the
That's
policy.
is that written into the
It's
policy?
written
That is
in,
written
it's
into
exactly
policy.
what we discussed in a lot of our meetings.
Good.
So this
Yeah.
is exactly how we've worked with Marcia
Yeah.
to form this. Actually, Marcia
And
did it,
Steve,
and Steve, and we ad-libbed a little bit.
Yeah, no,
But
this is
it's
great.
ready for us to vote on, as far as I'm concerned. So, hearing no more questions, I'll bring it to vote. All those in favor? Aye.
Aye.
Motion passes 4-0. So Marcia, one policy down.
There we go.
On to the next.
Well done.
Alright, we have no other new business, any other business that you wanna talk about? I'll bring up a few things under new items. We have an RBAC committee that I'm a member of, that we should maybe review and change up, and someone else can be on the RBAC committee. And the ARPA committee, now that we have a new board, maybe someone else should be a part of that ARPA committee. So we can bring that up at discussion at the next meeting, and again, get some input from the first selectman and the transition team on this, to see what direction they're headed, because I won't be seeing the first selectman probably until the next meeting. So I think we're gonna need input.
So we add that to next month,
Sure.
or back in our committee.
Yeah.
Because I think maybe we should change up on
Okay.
that.
Do you know when the ARPA meets?
ARPA's next meeting is November 17th.
Yeah, next
It's
one's-
a public meeting, the 18th is a other meeting. I will go to those, but after that, probably.
Yeah, the RBAC you're talking about is the 18th.
RBAC is the 18th as well, that's,
Our back is the third Thursday of the month.
And ARPA is the same?
no, ARPA is random dates.
And I think they want to meet twice a month, ARPA. I think they've been trying to, so I don't know if that's
They're having issues with,
quorums.
yeah, getting people together.
That's a pretty big group, isn't it?
I think that it's, was 5 people the last time, so,
What constitutes a forum for that?
I don't know.
Oh, okay.
Not my thing. Alright. We have no other public comment, so who wants to Mulvaney us?
I'll make a motion to adjourn.
I'll second. All those in favor? Aye.
Aye.
Thank you all for watching, have a good night.